Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, let's unpack this. We have to start with the numbers that define this hyper-growth story. The word growth doesn't really do it justice. It's more like a vertical takeoff.
It really is. I mean, the sheer speed is the core thing for any investor to grasp here. We saw Q3 2025 revenue, and it came in at $146 million.
Which, on its own, sounds modest next to the big guys.
Exactly. It's not the absolute number, it's the growth rate.
Yeah.
We're talking a phenomenal 355% year-over-year surge. This isn't just, expansion. It's them trying to dominate a very specific niche.
355%. That just doesn't happen by accident. And if you dig in a bit, that growth isn't even spread out, is it? It's all coming from one place.
Absolutely. The engine here is their core AI infrastructure segment. That part accounts for almost 90% of their total revenue.
Wow.
And that segment alone grew about 400% year over year. But here's the real insight, the thing you have to zero in on for management's comments.
Okay.
They've repeatedly said their capacity is, and this is their word, sold out.
Wait, sold out. That phrase completely changes the math on this, doesn't it? It means their problem isn't demand.
It's a supply problem. Precisely. It tells you that their growth right now is capped only by how fast they can physically build data centers and get GPUs online.
So they're in a race for capacity.
The biggest race. Think about it. They're competing for power, for fiber, for those high-end chips. Winning the CapEx war is winning the capacity war. And right now, their customer demand is it's miles ahead of what they can deliver today.
So they have a waiting list of customers. That's incredible. Okay, so being sold out today is one thing, but that brings us to the real foundation of the bull case.
Yeah.
The mega deals that guarantee demand for years.
Right. And this is why management is so confident just betting the farm on this aggressive spending.
Here you go.
They have this staggering backlog of contracts they've already locked in.
And these aren't small clients.
Not at all. These are strategic multi-year agreements with, the absolute titans of tech.
And when you look at the size of these deals, next to that $146 million quarterly revenue, I mean, the scale is just breathtaking. This is that aha moment, right?
Yeah.
Realizing the spending is for revenue that's already on the books.
Start with the crown jewel,
Yeah.
the Microsoft deal. It's a confirmed multi-year contract, and it's valued between, get this, $17.4 billion and $19.4 billion.
Billion with the B.
With a B. And it runs through 2031. That one contract provides almost a decade of revenue visibility.
And that's not even the only one.
Exactly. They also locked in a huge multi-year contract with Meta Platforms. That one's valued at around $3 billion over 5 years.
Need you combine those two.
And you realize Nebius isn't just selling a promise. They're building to fulfill contracts that already dwarf their current valuation. It just fundamentally changes the risk profile of the investment.
But I have to push back a bit here. Why? Why are Microsoft and Meta, these giants with their own massive cloud infrastructure, outsourcing billions of dollars of this work to Nebius Group?
That's the key question.
What's stopping them from just building this themselves? What is the actual moat here?
The moat is, it's layered. It's built on extreme technical optimization and a really clever regulatory strategy. First, the technical lock-in is profound.
So high switching costs?
Astronomical switching costs. This isn't just general cloud compute. When a client deploys their models on the Nebius platform, moving is a nightmare.
How much of a nightmare are we talking?
Well, estimates suggest that for a big enterprise to migrate all that data, retrain their AI models somewhere else, it could cost over $2.1 million. It's a huge sunk cost.
So you're not just renting a server rack, you're basically embedding a new nervous system into your operation.
Precisely. And the second layer is their proprietary efficiency. They have software like Nebius OptiGPU, which reportedly cuts idle time by 68%, and their flow software optimizes workloads.
And that saves the customer real money.
Directly. Clients say they can reduce their cost per token, which is the key metric in AI, by about 22% compared to the alternatives. You're buying speed and efficiency.
That's a strong technical edge, but there's a geopolitical layer, too, with them being based in Europe, right?
This is the third and often overlooked piece of the moat, the sovereign cloud benefit. Nebius is an EU-based company with full GDPR plus certification. That's non-negotiable for sectors like finance and government in Europe.
Okay, how does that help them with U.S. clients like Microsoft?
Yeah, that's the clever part.
Yeah.
They've engineered their network to provide U.S. clients with low latency access. So they offer this crucial US-EU hybrid access without the regulatory headaches a big American hyperscaler might face.
So they've solved the tech problem and the compliance problem at the same time. Okay, let's pivot to the price tag for all this. It sounds expensive. Why are they spending so much money right now?
They're in what you could call a capacity sprint.
Mm.
Management dramatically raised their 2025 CapEx guidance from an initial $2 billion all the way up to $5 billion.
$5 billion. And that's all going to...
80% of it is going directly to new data centers and GPUs, securing the power, securing the land, and securing the chips to fulfill those big contracts.
A $5 billion CapEx plan is just... It's astronomical for a company this size. How are they funding this? They're betting the entire company on this build-out.
And they've been incredibly successful at raising that capital, which is a huge signal of confidence from the market. They did a couple of massive convertible note offerings in 2025, raising $3.75 billion.
Okay, for our listeners, can you break that down? What exactly is a convertible note, and why is the low interest rate they got, like 1.00%, so important?
Sure. A convertible note is basically debt that can be turned into stock later on if the stock does well. And when investors lend you that money for only 1.00% interest, it means they have profound belief in the company.
Right. They don't care about the tiny interest payment.
They don't. They are overwhelmingly confident that the stock price is going to fly past the conversion price, and that's where they'll make their real money, when they convert that debt into equity.
So the financing itself is a bullish signal. The market is saying, we trust you. But with all this spending, what does profitability actually look like? Massive CapEx usually means massive losses.
And this is where you have to look closely. Their unit economics are actually very strong. Gross margin is excellent at over 59%.
That's healthy.
Very healthy. And inside that core AI infrastructure business, the adjusted EBITDA margin hit nearly 19% in the last quarter. That shows the service itself is highly profitable.
But if they're spending $5 billion in CapEx, the overall free cash flow has to be taking a massive hit.
Oh, absolutely. And that's the strategic trade-off. Their free cash flow is negative because of that $5 billion sprint. They aren't doing dividends, no buybacks. They are prioritizing a land grab for capacity.
But they still expect to be profitable on an operating basis.
They do. They expect to be adjusted EBITDA positive at the group level by the end of 2025, even with all the investment.
Okay, so let's be clear for everyone listening. The cash is flying out the door to build for future revenue. But the core business, before you factor in that huge investment, is actually making money.
That is the perfect way to put it. They're sacrificing cash today to lock in billions in recurring revenue for tomorrow.
This is where we need to bring in some healthy skepticism, because with this kind of growth and spending, you have to talk about the risks. What if they can't execute this build-out fast enough?
And that's the number one risk, the capital intensity and the cash burn. The Q3 net loss was almost $120 million. This aggressive spending creates huge short-term pressure if they hit construction delays or can't get chips.
Then that $5 billion is just tied up with no revenue coming in.
Exactly. And that leads directly to the second risk, dilution.
From them needing to raise more cash.
Right. They have something called an at-the-market or ATM equity program. It allows them to sell up to 25 million shares into the market.
And at the market just means they can sort of drip the shares out when the price is good instead of doing one big price-crushing offering.
You got it. It's a smart way to do it. But at the end of the day, if they need cash and use that program, it's still potential dilution for the shareholders who are already in.
Then there's the customer concentration. Those two mega deals are the whole story, which is also a huge vulnerability.
It's a critical risk. They are heavily reliant on Microsoft and Meta. If anything disrupts those contracts, a change in strategy, a slowdown in their AI spending, it would torpedo Nebius Group's whole outlook.
And finally, you have to look at the valuation. A company growing like this,
Yeah,
expectations are already sky high.
that's putting it mildly. The forward PE ratio is sitting at over 400. That's not a stock, it's a belief system. It means the market is pricing in flawless execution for years. If they stumble even a little,
The premium could just evaporate.
it could, and that could trigger a major correction.
Okay, that's a clear bear case, but the stock has been a monster performer this year, up over 200%. How are the big institutions looking at this, especially after the recent 30% pullback?
Well, despite all those risks, institutional conviction seems to be incredibly high. The stock pulled back sharply from its October highs and is trading below $100 right now.
And the analyst consensus on that drop?
The broad view is that this is a buyable dip, a healthy consolidation after that parabolic run, Most analysts still have a strong buy on it, with price targets up to $157. And institutional ownership is high and growing. The smart money seems to believe in the long-term story.
So looking ahead then, for anyone watching this over the next few months, what are the key catalysts? What should they be looking for?
The number one make-or-break event is the Q4 2025 earnings release. That's expected in late February 2026.
And that's all about execution.
All about execution. They need to show they actually deployed that $5 billion in CapEx, that the capacity is coming online. And just as important, they need to give clear 2026 guidance that validates those huge revenue targets from the Microsoft and Meta deals.
So it's about proof and visibility. What about other sort of market mechanics?
There's the scheduled ETF rebalancing around December 15th. If Nebius gets included in a major index or its weighting goes up, that could drive a ton of passive institutional buying.
A liquidity boost, basically.
Right. And finally, you have the rumors, the speculation.
The next big deal.
The market is always anticipating it. There's constant speculation about another hyperscaler partnership. And, given how specialized their infrastructure is, there's always M&A chatter, either them buying someone smaller or a giant player trying to acquire them outright.
So what this all means for you is you have this company in extreme growth mode, backed by massive defensible contracts, but they're taking on huge capital risk to get there, funding it with debt and potentially diluting shares. It really is the ultimate high-stakes AI infrastructure play.
It is. The core conflict is that risk versus that reward, all fueled by this incredible urgency. But the final provocative thought you should hold on to is that this whole battle comes down to physical capacity. It's not just about software. It's about raw power, GPUs, and data center sites.
The land grab.
The capacity land grab. Nebius Group's ability to actually execute that $5 billion deployment to lock in the power, the land, and the chips before their competitors, that might be the single biggest factor that determines their success. If they win this land grab, they are in a prime position to capture the future of AI compute. If you want more insights like this, be sure to subscribe to Investing Talk podcast.